Our first speaker is Debbie Pearl-Weinberg. She is Executive Director of Tax and Estate Planning at CIBC Wealth Strategies Group. She is a tax and estate planning lawyer, having been called to the bar in 1989, and is Executive Director I've mentioned that already, with CIBC Wealth Strategies Group. She writes and consults on a variety of personal and small business tax issues on behalf of CIBC's clients, and is presently the chair of the Investment Fund Institute of Canada's Taxation Working Group, and sits on a number of other subgroups as well with IFIC. So with that, I'm going to ask Debbie Pearl-Weinberg to speak, and then once she is done with her presentation, which I understand is a little bit more of a technical briefing on the particular changes that are being proposed, I'll introduce Dan Kelley from the Canadian Federation of Independent Business as well. So, Debbie.
Thanks very much, Mike. Just going to move this down a bit. So I'm going to talk to you today about the proposed changes, and I'm going to talk to you about these changes both in the context of your clients. You're going to, I'm sure, many clients who are small business owners. As well, I would venture a guess that a number of people in the room or your colleagues have professional corporations, and so these rules are quite relevant to you.
What's going on?
Is it on slideshow presentation?
Technical glitches are always the fun.
Well, I'll just talk as we try to get this. So, essentially, the government. If you can go to the let's see if it's working now. Ah, here we go. Thank you very much. So, the government has intended to, or signaled its intention to address 3 problem areas that they saw with private corporations. Now, this happened in the 2017 federal budget. They first announced that they were concerned about these things. Three items on their agenda. The first was income sprinkling using private corporations, holding passive investments in a corporation, and converting a corporation's ordinary income or dividend income into capital gains. So what happened in July 18th, the government came out with a position paper. It was accompanied by draft legislation for 2 of the 3 proposals. And as people might recall, there was a bit of an outpouring of concern about these proposals. There were a lot of writings in the press about it, and there were quite a few submissions on these proposals. As a matter of fact, in my many years of practice, I've never seen so many submissions going into the Department of Finance on proposals. And so it's quite clear from the number, 21,000 submissions to the government on these. And it was a very short period. It was a very short consultation period. Came out July 18th, and consultation period ended October 2nd. That's around 75 days for comments, and over the summer typical vacation period. So it's quite clear that it wasn't just industry associations, it was not just tax practitioners, but it was individual taxpayers, individual business owners who were making submissions. If anybody has interest, we actually did up at CIBC a report on the proposals, and again, when the proposals were revised, and you can get a copy of that on our website. So I'm going to go quickly over each of the proposals, what was originally put out in July, and how and if it was changed in October. So the first was sprinkling income, and there were 2 aspects to the original proposal. One was an extension of what I'm going to call the kiddie tax, and that's a tax on splitting dividend income. And the second was they were quite concerned about people multiplying use of the lifetime capital gains exemption. And this is an exemption where over $800,000 of capital gains on the disposition of qualifying small business corporations can be sheltered from tax. So the government was originally quite concerned that people were multiplying this, especially using family trust structures. So, brief background on the existing situation on splitting income and what proposals are out there. So first of all, if you have a corporation, a business, you can pay reasonable salaries to family members, to related people, without any adverse tax consequences, and this has not changed. But again, the key word is reasonable. It has to be reasonable for the work performed. Under the current rules, you can have a corporation and you can have shareholders being family members. It can be a small business corporation. And often this is done through an estate freeze where the value of the original business owner's shares are frozen for tax purposes. So they're locked in at whatever their value is as of the day of the estate freeze. And then family members can subscribe to new shares and participate in the growth of the corporation and get dividends as well. And that's often done by use of a family trust. Currently, you have to worry about both attribution rules, tax rules I'm not going to go into, and kiddie tax. So the one thing you had to be concerned about was you couldn't put a child under the age of 18 as a shareholder or flow any dividends to a child under the age of 18, because under the kiddie tax rule, you wouldn't be saving any tax. They'd be taxed at the highest rate of income, highest rate of tax. Now, in terms of you personally, if you have a professional corporation, the Law Society of Upper Canada rules on professional corporations. Not sure if our name has changed yet, but at any rate, the rules for professional corporations prohibit anybody but a lawyer from owning shares in a professional corporation. So unless you have, two spouses who are lawyers, you have a child who's a lawyer who's, not working, etc., it was pretty difficult to split income unless you're paying a reasonable salary. But what a lot of professional corporations do, certainly if there's a partnership that warrants it, there's the use of management companies or real estate holding companies. So sometimes people might be splitting income through that and having family trust as the shareholder in the management company that that earns some of the income. So again, current state of affairs, only had to worry about kiddie tax, only those under the age of 18. And you can see that you can save a fair bit of tax by flowing dividend income out to somebody who doesn't have any other tax. There's two different types of dividends that come out. If you can see this chart, the top row is what's called eligible dividends. The bottom row is ineligible dividends. And you can see for Ontario, eligible dividends, you can pay out over $50,000 of dividends before somebody will be taxable. And for non-eligible, it's over $33,000. These are 2017 numbers. Whether a dividend is eligible or ineligible, it depends how it's taxed in the corporation. Generally speaking, if something is subject to a higher rate of tax in the corporation, then it comes out as an eligible dividend. That would be a lot of public company dividends. For private company shares, if it's taxed at the lower tax rate, the small business tax rate, first $500,000 of active business income, then it'll be an ineligible dividend when it's paid out. So how have the rules changed? Well, the first and foremost, or how are they proposed to be changed, is that this tax on split income, the old kiddie tax, will now apply to all age groups, under and over age 18. And if you are over age 18, you will be subject to this tax on split income if you receive a dividend from a private corporation, unless it is considered reasonable. And this is a new reasonableness test that is set out in the draft legislation and the proposals. And it's based on three criteria: your labor contributions to the corporation, your capital contributions, and your previous returns and remuneration. So it's a fairly subjective test, as you can see. And I'm going to go through the reasonableness test, but a much higher standard will apply for those aged 18 to 24. So even within the over age 18, then you have two different tests depending on whether or not you're under age 25. In addition, the test has been expanded to include other types of forms of income, such as interest. So you can't get out of the rules by putting in, a loan structure rather than purely a shareholding structure. So, the big thing is it's going to impact many shares received during an estate freeze, and it could impact as well many professional corporations that use a management company structure or a real estate holding company structure. So the reasonableness test. I just want to outline a little bit to show you how it's different depending on age. So for labor contributions, generally it's based on the fair market value of services provided, except if you're under age 24. Then your services have to be regular, continuous, and substantial, and you have to be actively engaged. Not sure exactly what that means and how it will be interpreted by CRA or the courts, but that's what it says right now in the draft legislation. In terms of capital contributions, generally it's a reasonable rate of return, except if you're under age 24. And then it's based on whatever the prescribed rate is under the Income Tax Act regulations. Right now, that is 1%. So that's a pretty low rate of return. Why did they do this? Well, if you look at the graph in front of you, the government looked at private company dividend payments. They looked at tax returns for a number of years. I think this shows 2006 to 2014. So 2006 is the dotted red line and 2014 is the yellow line. And you can see that there's an increase, a trend to an increase in dividend payments for that age group. You can see the jump from under age 18 to age 18 and up to this 24-year-old age group. And, the reason for that probably is, well, no kiddie tax applied, and this age group is either still in school or starting out in their careers and either have no income or have a low rate of income. So that is the perceived problem, and that's why they came up with these two different set of rules to confuse things even more. So I just want to go through a little example and show you how the reasonableness test could apply. And this is an example where someone's 24, so they're under the age of 25. So they're subject to the harsher test, the stricter test. So we have a 24-year-old named Jesse, and he receives $100,000 of dividends from a corporation that his father started and his father controls. Jesse actually did invest in this company. He invested $100,000 in preferred shares. He also works in the company. So he passes that test. He's actively engaged on a regular and continuous and substantial basis. The labor that he puts in, the fair market value of that would be, let's say, $50,000, but Jesse only receives $30,000 in salary. So what would be a reasonable dividend paid to him and what would be unreasonable? Well, the total dividends are $100,000. Let's subtract the reasonable dividends. He put in $100,000, but he's subject to that 1% prescribed rate of return. It's only $1,000. So of that $100,000, only 1%, $1,000 would be reasonable under his capital contributions. His labor contributions, well, he worked and should have been, the fair market value of his labor was $50,000. He only took out $30,000. So another $20,000 can be considered a reasonable dividend. So the unreasonable amount of that dividend is $79,000. So Small Business Week this year was the week of October 16th, and the government was very nice to tax practitioners across the country, and all through that week they sprinkled changes to these new small business measures. So the first thing they did was to this income sprinkling measure, and what they said is that they're going to simplify this measure. Not sure exactly what that means, but there were a lot of submissions about the complexity of this and how difficult it would be to determine whether or not, dividends paid were reasonable. There was a lot of other submissions about the, unfairness of this for people who have, planned their retirement in this way by putting money into a corporation and planning on income splitting in retirement. Just quoting from what they said, they aim to simplify the proposed measures with the aim of providing greater certainty for families who contribute to a family business and reducing the compliance burden. We have no idea what that means. They also recognized angel investors. There was a lot of concern that angel investors would no longer be willing to invest capital in new startups because of the concern that dividends paid to them would not be reasonable. So they also indicated that they're going to recognize angel investors in the new draft legislation, and they are going to recognize that an investment in a startup carries greater risk and may warrant a relatively high return under a reasonableness standard. The revised last draft legislation is set to be released sometime this fall. Not sure exactly when that is. We're waiting in anticipation for it. But these proposals are supposed to be effective as January 1, 2018 for dividends paid after that date. The closer we get to that date, the more that we say, will this be postponed? But, we haven't heard anything about that. The other big announcement on October 16th was that they were not proceeding with a measure to limit multiplication of the lifetime capital gains exemption. So that was really big. But because before that, there was really no reason to enter into estate freezes. Now there could be a reason. If you want to just simply, defer, there might be a reason to do that and multiply. So what should people be thinking about? What should you be thinking about? Or what should be telling clients to think about? The big thing right now, sitting where we are November 10th, is if they have something that could be subject to these new measures in 2018, speak to their accountant, look at tax returns, and determine whether additional dividends should be paid out this year so that they're not subject to TOSI in 2018. So that's a big thing. Just think about that. As of 2018, or whenever these measures come into play, think about this reasonableness test before dividends are paid. For 18 to 24-year-olds, if they are, working or have contributed capital to a business, think about if you might need to delay payment of dividends to them until they've reached age 25. Consider the rules before entering into an estate freeze. Think of why a client might want to enter into an estate freeze. Consider the rules before setting up a new business with funding from a family member or a guarantee from a family member, because as the draft legislation is right now, that could impact how dividends paid are treated. And the other thing is, might want to consider whether you need to do a corporate reorganization. And the reason for that is just because if you have to, if people hold the same class of shares and you have to pay under corporate law equal dividends to all shareholders of a class, and you have one individual who would receive reasonable dividends and another individual who would receive unreasonable dividends, you might want to do a reorganization so they're not members of the same share class. But that's something, think about once the rules actually, we see further draft proposals and know that they're coming into play. The next area that they're targeting is passive investments in a corporation. And just to go over this, I'm going to just go through a basic exercise in how income inside a corporation is invested and treated for tax purposes. So assume that a corporation earns $100,000 of income, and I'm going to go through this assuming that they're eligible for the small business deduction. So they earn $100,000 of income, and they are going to pay tax, corporate tax of $14,500. That allows them $85,500 of after-tax income. They can either invest it in the corporation or they can pay it out. So if they pay it out, then you're going to have the $85,500 flow to a shareholder, and that shareholder will pay tax of $35,000, and after tax, the shareholder would have in their hands $50,500. Now, if that shareholder earned that money personally instead of through the corporation, so they earn $100,000, if they're in the highest tax bracket, assume that they're going to pay tax of about $49,500. So after tax, this is a perfect integration. It doesn't actually work this way in reality. It doesn't match up perfectly, and depending on the province, you can be a little better off tax rate advantage or tax rate disadvantage of earning in a corporation. But you can see that the theory behind it is that you should be indifferent earning money through a corporation or not. So that's the tax rate. But the big thing to notice is this tax deferral advantage. In here, this example, it's 35%. Because after tax, if you were an employee and you earned that money directly, you'd have $50,000, assuming you don't need it for living, you'd have $50,500 to invest and have that grow. If instead of paying it out, you kept it in the corporation, you'd have a capital base, an investment base of $85,500. And if you let that grow over a number of years, then at the end of the day, even when you have to pay tax after taking it out of your corporation, you'd have a tax deferral advantage and you'd be in a better situation. You'd have more money. And the longer you keep it in there, the longer that occurs. The reason the government had concern about that is that over time, this chart shows that there's been a growing gap between personal and corporate tax rate, and depending on whether or not you're taxed at the small business rate or the higher rate for income over $500,000, you can see how big that deferral is. This shows the deferral advantage by province, and again, you can see for Ontario, you're looking for small business deduction income, the first $500,000 of income, it's a 38.5%. And for income above that $500,000, it's 27%. So not just your clients, but you. If you have a professional corporation, what tax rate are you guys paying? Now, if you're sole practitioner, you will be, definitely eligible for, that $500,000 rate on your first $500,000 of earning. But if you practice in partnership or an association at all, you have to be concerned that you might have to share that $500,000 limit. Up until a couple of years ago, even if you were in a partnership, there was a way to structure the partnership. Large partnerships didn't do this. They just shared the $500,000 limit. But for some smaller partnerships, there was a way to structure it that they didn't have to share the $500,000 limit. The 2016 federal budget put an end to that. So for most professional corporations, you have to share that limit. At any rate, whether it's the small business limit or the higher limit, the government perceived that as unfair. And in the July paper, they set out some ways that they might want to change it. They didn't have any draft legislation because it's so complicated. They were just thinking through it. But after, that was announced, people went through the numbers and said, you know what? It can go as high as a 73% tax rate on this. So there was a lot of outcry about that. Very, very complicated set of rules. And also, it would only apply to new investments. So how do you trace? How do you apportion? How do you pay out dividends? All very, very, very complicated. So Oh, sorry, I went a little too quickly. One thing that we were surprised to see in the small business tax week is that they actually put in place an announcement that they're actually going to decrease the small business tax rate over the next couple years. This is something the Conservatives had in place. They canceled it. Now they're putting in something, so by 2019, you're looking at a 9% small business federal tax rate. Just a little surprising, given that they were concerned about the tax rate differential. Now they're going to make it higher. Anyways, I can't figure it out. But some good news came out of Small Business Week. What they did say, first of all, they clarified again and again that this will only apply to new investments. And they also put in place a $50,000 threshold. The reason for this is that there was a lot of complaints about true small businesses, that, how are they supposed to track things? So this will help the small business. It's meant to be a proxy for about $1 million in savings at a 5% rate of return. They also talked about venture capital investments, and because there was a lot of concern that this will stop a lot of investment in venture capital corporations, because either it'll be taxed at a really high rate within private corporations, or if they're just putting funds aside to wait for the next venture capital investment. So they did indicate that they're going to take that into account. But we have to wait for the 2018 federal budget. So what to do now? Well, no need to withdraw funds, because they've said over and over current funds and income on current funds and income on current investments will be grandfathered. But we always have suggested that you are better off if you compare rates of returns within corporate savings versus an RRSP or a TFSA. You're going to be better off taking the funds out of a corporation long term and investing them in an RSP or a TFSA. The chart that I have in front of you just shows you a little bit. We played with some numbers here, and that dark red line, the 46,200, is what you would earn in an RSP, and you can see it does better than any type of investing other than deferred capital gains. And the fact is that nobody, for 30 years doesn't recognize a capital gain. That would be very, very, very unusual. The last thing I'm going to talk about very quickly is the government's proposal about converting capital gains into, or dividends into capital gains. This is something that they were really concerned about. There already were anti-avoidance rules in place, but they were concerned they didn't go far enough. A big concern about them, everything from corporate-owned life insurance to pipeline transactions, post-mortem planning was under attack. Good announcement, they stopped those proposals. They are not going forward with those at all. Corporate-owned insurance, I'm going to bring it up a little bit because we get questions constantly, every day on this. And the answer is, first of all, they're not going ahead with the proposal about converting ordinary income to capital gain. So that concern that was there is out of the table. In terms of passive investments, it does appear that right now, if you're concerned that, as of the date whenever the new passive investment rules come into place, that you will build up over $1 million in capital, you'll earn more than $50,000 in investment income on retained earnings earned after that date. What about corporate-owned life insurance? Could that be an option? Right now it looks like it is, but we'll need to see the rules when they come out. The same for individual pension plans. So if you were a client, just thinking about that. Where are we now? Okay, so this is a summary. Tax on split income. There still is, but they're going to simplify it, and they're looking at what to do for angel investors. For the lifetime capital gains exemption, the proposals have been withdrawn. Passive investments, they still say they're moving ahead with it. We won't see details until the federal budget. $50,000 threshold and go-forward investments only. Converting dividends to capital gains, they have withdrawn. And with that, I suspect I'm over time. I apologize, but I'll hand it over to the next speaker.
Thank you, Debbie. That was very timely, very topical. Are there any burning questions of a more technical nature that we want to answer now? Okay, seeing none, we'll move on. I'd also like to know how I get 5% return on my passive investments and $1 million to put into the account to begin with. But anyway, so the next presenter we have is Dan Kelley, who serves as the President, Chief Executive Officer, and Chair of the Board of Governors of the Canadian Federation of Independent Business. We're obviously very honored to have him here today. He is the lead spokesperson and advocate for the views of the Federation. The Federation's 109,000 small and medium-sized member businesses across Canada. He joined the CFIB in 1994 and has worked his way up through a variety of roles of the CFIB and is now into his new role as to his current role as the Chair and CEO. And he's been especially busy in the last number of months in light of the changes to small business tax. I'm also excited to have him here, and just wanted to call this out because he and his colleague Chris, who's sitting over in the corner, we're going to be having a conversation afterwards about finding ways that FOLA and the CFIB might be able to work together and support business in Ontario and all of you as well going forward. So I'm most interested in the conversation after this conversation. But in the meantime, I'll turn it over to Dan Kelley to walk through some of what the Coalition on Small Business Tax Fairness is working on. Thank you, Dan.
Thank you. Well, thank you, Michael, and terrific to be here. Debbie, that was a terrific summary of some of these changes. This has been, these were coming in around Halloween, and it was a fairly scary package altogether. The last 4 months have been a pretty busy set of days for us at CFIB. We have been full on in analyzing and then fighting these tax changes, and I'm really happy to be able to share a few thoughts from our perspective of how this has all gone. We've been doing this a long time at CFIB, defending small and medium-sized businesses against government policies of all kinds. We are a nonpartisan political action organization. We do spend a lot of time analyzing government policies and then responding to them. But I have to tell you, I've been doing this now for 23, coming on 24 years. CFIB has been in existence for 46 years, and I have never seen the degree of anger, spontaneous anger, on the part of business owners in my time with the Federation. And in talking to our chair, John Bullock, the man who founded our organization back in 1971, he says that this is very reminiscent of some of the very early fights that the Federation had that precipitated the founding of the Canadian Federation of Independent Business. So I thought I'd share that with you. I'm not going to go into the tax changes themselves. Debbie explained them certainly far better than I would be able to. I just wanted to talk to you about some of the reasons why these provisions for small firms existed in the first place, because I think that that's gotten lost in some of the discussions. Finance bureaucrats are very patient, and they have been sitting and waiting for a government that would be willing to take them up on some of the ideas they've had for changes to the corporate tax structures that affect private businesses. But CFIB has also been around a long time, and we're a fairly patient lot. We have fought this back a couple of times now, around the founding of CFIB in 1971, and then again in the early 80s. Alan McEachen was finance minister at that time. He recently passed away, and he took another swing at this and tried to make some changes to the small business rate. And of course, there was a pretty significant backlash from small and medium-sized firms at that time too. But in looking at why the lower rate of taxation on small firms exists in the first place, these are the main reasons. One, small firms have a more difficult time of accessing financing than their larger counterparts. So the whole concept behind the lower rate of taxation on small firms is that by allowing a small business to hang on to more of their own retained earnings, they can pump that back into growing the business for the future. And that seems to have been lost. Secondly, and this has certainly come out recently with respect to some of the offshore tax shelters, small firms have more limited access to some of these ways of saving on the tax burden. And their overall tax burden has been shown to actually be higher than their larger counterparts. A small firm also has all of the same compliance costs with the tax burden that a large firm does, but they do that on a much smaller basis, a much smaller base of revenue. And that often is used as one of the reasons why small firms have a lower rate of taxation. And somehow that has gotten lost in this discussion. So why did the federal government go down this road in the first place? Of course, they're talking, the Prime Minister was talking about it as closing loopholes. They talked about it with respect to tax fairness. When I've been asked this question, the only really sensible explanation from my perspective is that during the last election campaign, the 2015 election campaign, the Prime Minister campaigned on the notion that wealthy Canadians should be asked to pay a little bit more to help the beleaguered middle class. That campaign worked. That certainly was part of the success of the federal Liberals, and they wanted to double down on that since it seemed to have worked. In fact, when the changes went into effect, when they raised the top tax rate shortly after becoming elected, there wasn't a huge outcry from Canadians on this front at all. And so they thought that they could do this again and address this issue. In fact, I think that is even the bigger issue, the bigger reason behind this than the need for revenue, which is an obvious one that their government has. But this idea that this political narrative of going after the rich guy, having seen that work in 2015, they thought they could do this again in 2017, and that might set them up well for the future. But it didn't work. And I pointed out that the flaw in the theory is that Canada started to run out of rich people for the federal government to go after. And so they started to go after small and medium-sized business owners. And yes, some of them are well off and doing well. And you know what? I think in Canada we're losing something if we don't celebrate that from time to time. Unfortunately, that seems not to be allowed in the current political narrative. And so they pushed this into the whole umbrella of tax fairness, ensuring that the tax system was being fair to Canadians. And they started to compare the taxes affecting business owners in the same, they wanted that to be basically in the same category as the tax burden affecting employees. And yes, of course, I think everybody is behind tax fairness, but these are two fundamentally different things, an employee versus an employer. We pointed out if the federal government and governments in general were really serious about tax fairness, they might look at some of these other forms of taxation. For example, that the business owner has to pay double the rate of Canada Pension Plan premiums compared to the employee. The fact that the employer pays 1.4 times the employment insurance rate that their employee does. Meanwhile, the benefits of the employment insurance system are for employees, not for the employer. Property-based taxes, that a commercial property and a residential property of the exact same assessed value, depending on where you are in Canada, attracts 2 to 5 times more property tax than the same valued residential property. Workers' compensation, WSIB here in Ontario, 100% paid by the employer, no contribution from the employee. EHT here in Ontario, or payroll taxes, again, 100% paid by the employer, not by the employee. And if they really wanted to think about fairness, what about these factors? The fact that the business owner is taking all of the risk, that they're perhaps mortgaging their home in order to get the business going, unlike the employee. That the business owner gets paid last, and I can't tell you how many business owners have told me that when they look at their hourly rate sometimes, it is less than that they are paying their employees. Some have suggested less than the new $15 an hour minimum wage that Ontario is pursuing. The fact that employers are unpaid tax collectors. Whenever you pay the 13% GST or the 13% HST here in Ontario, if you pay on your credit card, the employer has to eat that transaction fee of about 2% on every transaction. That amounts to, if you can believe it, $500 million in Canada that businesses are paying not for their own benefit, but to collect these sales taxes that they have to remit to the Government of Canada and to provincial governments. Working hours, vacation time, benefits and pensions, of course, are also some big differences. And of course, in dealing with a lot of tax professionals about one of the set of proposals, the passive income proposals that were the source of much of the controversy, The tax rate differential was quite staggering. And there were scenarios that were being proposed and still exist now where the effective tax rate on passive income, on interest income, would hit 73% for the business owner. And I'm not sure whose definition of fairness that meets. Certainly not that, I would suggest, of the average Canadian. So the business community started to come together, and I'm super happy that the Federation of Ontario Law Associations joined with almost now 80 associations across Canada. This isn't even up to date. We've had associations join even after the federal government started to climb down from these changes. But this has become an unprecedented fight. Some of these business associations fight each other on a day-to-day basis. They don't like each other very well. But they came together in response to these changes that the federal government had proposed because they know how serious these changes are. And I have to tell you that, in my experience, just does not happen very often. You know, these threats were very, very serious. The Prime Minister of Canada was at the United Nations 2 weeks before they started to climb down, and announced, wasn't talking about North Korea or our peacekeeping missions, but was talking about the changes he was making to the small business corporate tax structures. This was at the UN, weeks before they started to close the consultations. So if anyone thinks that this was just a trial balloon that the government had floated, I can tell you it was very much not the case. Now, fortunately, the stars aligned a little bit for us, because there were some other issues that started to creep into the system that the government started to become a bit sensitive about. In addition to the business backlash, there were some personal and party issues that the federal government started to deal with, including our finance minister's personal tax situation. Now, look, I am of the belief that I don't put any stock in the view that our finance minister, Bill Morneau, did any of this for personal gain. I don't know him terribly well, but people that do know him describe him as a very honorable man, and I believe that. But it certainly didn't hurt the opposition to this that the finance minister's personal situation, his own trusts, and his own direct or indirect business relationships were factored into this. And then, of course, in more recent days, the whole offshore issue and tax shelter issue has crept into the system. And so just reinforcing, I think, some of the things that Debbie was discussing, I wanted to share with you where we are now. Not just where we are with respect to the changes, but where we're going with respect to the combating the remaining portions, the remaining concerns that we have. On the positive side, we did give government credit, both from my organization, CFIB, and the larger coalition. We gave the government credit for their restoring their own promise to reduce the small business corporate tax rate to 9%. That was deader than a doornail a few months ago, but that has been resuscitated. We certainly were pleased, and I agree with you, Debbie, probably the biggest benefit of the changes, the climb down during Small Business Week, was the dropping of the provisions related to capital gains, and there's a few of them that were very, very troubling, and that has happened, so that's good news. I'm also pleased that they've started to recognize the important role that passive income can play in the life of a business and the life of a business owner. It is a start that they have at least acknowledged that they'll allow up to $50,000 in passive income from one's investments in the future. And probably more important than any of this, what I'm most pleased about is that the tone has begun to change in Ottawa. It is very troubling that the government thought that there was a political benefit by going after independent business owners and setting them up and suggesting that they're a bunch of tax cheats. And that wedge politics, the divisive politics, by saying independent business owners are the bad guys just trying to rob us blind and we have to do something about it, that was probably one of the most disturbing narratives that I've seen in a long, long time. And that didn't work. It seems that backfired on the federal government, and we had some role in causing it to backfire. So that is a big, big change, and hopefully one that will put a nail in the coffin of that kind of technique for the future. But where are we now? we still have major concerns with respect to the income sprinkling or income sharing provisions that are in this. We do think that this is going to lead to an increased overall tax burden for many families. 70% of our members, CFIB members, have a family member indirectly or directly involved in the business operation. We know that this is going to have huge red tape headaches for business owners to have to prove that the income that they share with their family, or the dividends now that they share with their family members in the business, that is a reasonable amount. We believe that this is going to create at least a decade of uncertainty as CRA has to put some new rules associated with this, and then those wind their way through the courts. That's going to be a very unhappy occasion, I think, for many businesses who will be subject to audit. And then with respect to the passive income, we really don't have any details yet as to where they're planning to go. It is unclear what this is going to do for future investments, but we know that there's not a lot of good that we can expect that will come out of this. So what do we do about these changes? Where do we go from here? One of the concerns that I have is that the general public kind of is of the view that after Small Business Week, when the government started to climb down, that this issue is done, that business is now happy and we can move on. But we just had a couple of coalition calls, and I can tell you the business community is not happy about these changes. Yes, there have been some improvements. We're pleased to see some changes made, but the remaining pieces are huge. These changes on the way that family income, the income sprinkling provisions, those are supposed to take effect as of January 1st, 2018, and it's now, what is it, November the 10th, and we have not seen a stitch of detail about this. Yes, they put the broad principles out, but there's been no detail provided to us as to what this is going to look like. It's mid-November, and this is supposed to be in place in about 6 weeks' time. So we're very worried about that. So what are we recommending? One, we want government to release all of the detail of the proposals right away, with a full economic impact assessment of each of the proposals, what it's going to do, what effect do they expect that will have on the economy, so we can validate that. We want them to build in an additional period of consultation. At minimum, with respect to the income sprinkling, we do want to see a full spousal exemption. To separate out the spouse in a family situation, if the home is remortgaged because to invest in the business, it's pretty hard to suggest that only one of the spouses should be the beneficiary of these shares. And in fact, for women, this is going to be particularly offensive. Over 2/3 of business shares are in the hands of men. And so when the income is shared, it's primarily women that would have, in most traditional relationships, a share of the business income as associated with that. I believe that what this is going to do is it's going to cause a lot of businesses to have to basically confer the benefits of the business to the spouse, and in most cases today, that's a male spouse. And that doesn't seem to pass the gender lens that the Prime Minister has been talking about an awful lot. So we're asking for a full spousal exemption from the income sharing rules. We want that delayed at least until 2019 so that we can see how this is going to work. And then on the passive income side, the coalition is recommending that this be dropped 100%. We don't see any good coming from these passive income rules. And at the very least, we need to go back to get the government to go back to the drawing board and provide something more reasonable. The $50,000 threshold, yes, will help a lot of very small business owners, but if you're a growing business, it's certainly not going to be of much value to you. So we've suggested that at the minimum, we at CFIB have suggested a $250,000 threshold, that be raised, which, according to the government's math, would be about a $5 million worth of passive investments. Also, one piece that there is some potential help on, a potential positive that could come out of this, the government has signaled that they are willing to look at and consider ways to make, if a business owner sells the business to the next generation, to say their kids, that they would fix the inequity, because right now, as we know, it is cheaper to sell your business to a stranger than it is to a family member. And the government has channeled that they are open to looking at ways to do that. There have been 2 recent private members' bills that have suggested that, one from the Liberals themselves and one from the NDP in the last Parliament. So what can we do about that today? I ask you to, if you are concerned about these two, and of course if you support the changes that the government's making, I invite you to do this as well, but to make sure that our members of Parliament hear about this. The main reason why this campaign was successful is that Liberal members of Parliament started to get nervous. Provincial governments started to get nervous. And the business community was very effective. I think the coalition and many organizations were very effective in reaching out to members of Parliament, particularly Liberals members of Parliament, to say to them that these changes are huge, they're going to have unintended consequences, and they need to be rethought. I think it's important that we get that message again to MPs that this is not over, because many of them have begun to move on to other issues. So it's been a very busy 4 months. I never in a million years thought that a technical set of changes affecting small business owners would be the lead national story for 4 straight months on political pages across the country. But it was. And that happened because independent business owners spoke out. That's why CFIB has existed for 46 years, to help independent business owners have the voice at the table. And I'm really pleased that we've been able to work so cooperatively with your association and, of course, with the broader business community in this effort. Thanks so much.